Let's now connect with Paul Schulte, Chief Executive Officer and Chairman of Schulte Research, who joins us with a quick global check. Paul, good morning and thank you for joining us. What is your view on the US economy? The Q1 GDP data disappointed, however, the job data has been encouraging.
Well, what we have in the U.S. is the Federal Reserve looking at the unemployment rate, which is falling very quickly, but there are more and more people falling out of the unemployment rolls who have stopped looking for work. We have millions of students in colleges with very expensive student loans who have a hard time finding work. There's a 2.2 million person population in prisons. And that is drawing great numbers of people away from the employment pool, and so the overall employment numbers of the percent of adults who are actually employed continues to fall. So this is weighing heavily on the Federal Reserve as it considers pulling quantitative easing. Secondly, we have inflation numbers which are falling below 1%. This is dramatically below the inflation expectations that are created by the Fed, which are 2% plus. So you have super low inflation and you have very low labor participation. That's why government bonds have rallied so hard. In the midst of this so-called good news, we've had the biggest rally in government bonds in 20 years last week. So these numbers are not perceived as good, and so I would continue to say, as I have for several years, more QE is coming.
Paul, hi, morning. What are your key takeaways from the FOMC meet, and what's the outlook on U.S. quantitative easing taper and decision on interest rates, and how do you see it impacting global liquidity?
Well, this is the thing, right? So everyone's talking about tapering being so terrible. I consider tapering is like the 300-pound sumo wrestler who's going on a diet and tells us he's going to go on a diet by gaining only 7 pounds instead of gaining only 9 pounds. So we still have 4 more tapers, which could be until the end of the year before the Fed balance sheet actually begins to shrink. But in the meantime, the Fed's balance sheet is going to continue to grow probably until the end of the year. And I think the deep, dark secret, the dirty little secret of the Fed is not going to raise rates until they're absolutely sure that we are growing above and beyond full capacity. I think they're not going to take a risk and blow 7 years of success by suddenly tightening and causing this whole thing to turn into a big mess. Don't forget, Japan is, very messy right now. Europe is very messy with, record high unemployment levels and record low inflation numbers, and China is messy right now. So the world is in a messy situation, and I think the Federal Reserve is acutely aware of this.
Paul, what is your outlook on growth in developed markets, and that could impact emerging markets and Asian economic growth? And would you prefer developed markets over emerging markets at the current juncture?
Right now, I think the best place to be in terms of equities, in terms of liquidity, in terms of leverage, banking systems, I believe strongly banking systems call the shots on financial markets. And right now, the healthiest banking system in the world is the United States banking system. The leverage levels are falling to 12 or below, making it one of the lowest leverage levels in the world. And the loan-to-deposit ratio is now coming on to 65, which is one of the most liquid banking systems in the world. The U.S. financial system is the most liquid and the least leveraged system in the world. After that, I think there are some systems in Southeast Asia, like Malaysia especially, which has fantastic levels of liquidity and very low levels of leverage and some of the highest returns on capital in the world. And then after that, we have some recovery stories in Southern Europe, like Greece and to a lesser extent Ireland. And then we have isolated spots like Canada, which are also very interesting. But in Asia, I think the brightest spot in Asia right now is in Malaysia, and I think also Indonesia.
Paul, most Asian currencies have gained last week. How do you see the dollar strength impact emerging market Asian currencies?
Well, I think that there are considerable, there's a lot of emerging market currencies which are drastically overvalued. I think one of the most overvalued in the world is Brazil. I think the second most overvalued is Australia. The euro is super overvalued. I think we're coming on to, better fair value in Southeast Asia, in particular Indonesia, Malaysia, even Thailand. And so I think we should be expecting a little more currency stability going forward. I think the appreciation of the RMB, I've been very public about this in my research, very explicit for several months now. I think the CNY has bottomed. And for the outside world is never going to be as cheap as it is now for mainland Chinese who are buying outbound assets. So this is the time for outbound FDI to really explode in China, and I think it will. I think it will grow by 10x. So currencies are having a very major impact on global flows right now. And the biggest winner in the Chinese weakness of the CNY is the outside world, namely technology in the U.S., technology in Europe, and also agricultural land and food technology.
Paul, what is your view on rupee? Because in quick time, rupee has strengthened quite dramatically from the recent low. In next 1 to 2 months, given the overhang of the political outcome, are you a rupee bear or a bull?
Well, I think that what we have in India is a constant, perpetual reliance on currency weakness to allow that to be the steam valve to allow the steam to be released from inflation. India has a chronic, non-stop inflation problem. Currency weakness is the result. And until and unless India gets its hands around the inflation problem in alliance with sort of out of control budget deficits, the currency is going to continue to remain perpetually weak. On top of that, India is a very big energy importer. I don't see oil prices going down anytime soon, and so we should expect pressure on the currency to continue. This, currency strength, I think, is somewhat temporary, but we should probably continue to think that currency weakness is going to be the name of the game for India for some time to come until they get their act together, both with respect to inflation and with respect to budget deficits.
Paul, so how do you see India's macros versus Asian and emerging market peers? Which Asian and emerging market peer do you think will stand to attract more foreign flows as opposed to India?
Well, I think that obviously India has become a heck of a lot cheaper in the last year with the currency weakness. But what is going to happen in 2014 and 2015 is that India is going to be importing a great deal more inflation. And so India, I think, will have just about the worst inflation problem of any emerging market except maybe, Vietnam and maybe a couple of others. And so, anybody who's investing in India needs to pay attention to what is going to become an accelerating inflation problem, both for goods and for wages. And so, when you talk to some of these people who have ongoing international outsourcing operations in India, wages are going up very fast, and there is not a commensurate increase in quality of the people who are seeing quickly rising wages. And so this could be a problem for the competitiveness of a very important industry in India, which is that outsourcing industry.
Do you see strong foreign flows to continue into Indian stocks, or is India at the start of a long bull market?
Well, I think that if you look at the banks, for instance, the banks in India are now among the most expensive banks in the world. They're trading at, 3 times book. They're trading at about 40, cents, for every $1 of market cap. That's one of the highest in the world. So the banks, to me, don't have a great deal of value. If you look at the other sectors, the valuations there are not compelling either. So I think that the equity market has largely been serving as an inflation hedge for India without sort of a commensurate, support by either falling interest rates or by, earnings. And so if the numerator, which is, earnings, and the denominator, which is interest rates, don't go in a favorable direction, I am dubious about the continuation of the Indian equity rally.